Today's Cardinal lesson is about cash value whole life insurance. Like, yippee, I can't wait. So, what we're going to share with you today is how we use life insurance, both types, term insurance and permanent insurance, in our financial plans to help people achieve their goals. And both have a place. And I want to turn it over to Tom. Tom, why are we doing this video today?
Yeah, I mean, we're doing this video because cash value life insurance often gets a bad rap in the media, right? You've heard this before, so maybe you've seen it where they say no one should buy whole life or cash value insurance, and we just want to push back on that, right? I think there are absolutely reasons and times where it makes sense, part of a larger financial plan, to consider it. So we just want to show you where those are, how they work, and why you might want to consider this. And so let me bring up the show notes. You can find this below our video here on YouTube, or you can find it on our website at cardinalguide.com. We have the board. We'll get into that in a second. And we just have some more details that are sort of supported on the board. So if you want to read more about the examples that we have, get a little bit more information, pull up the show notes, take a look at them, and then you can reach out if you have specific questions that aren't answered there. So let me turn it back to Hans, and we'll go over some examples of where this has been used historically and why you might want to consider it for yourself.
Okay. One of the reasons to have cash value in your life insurance policy is that you can go get it, you can borrow it, and use it without a tax effect, and then you can put it back. So you can have, in other words, you can get a loan very easily of your own money, is essentially what it is, and it has some very good tax procedures. So I want to go into history a little bit, and I want to let you know that Walt Disney borrowed 75 grand from his life insurance policy to put down the initial payment to build Disney World, which was before the TV and Mickey Mouse and all that kind of stuff. Ray Kroc borrowed substantial money from his whole life insurance in the 60s to expand McDonald's. J.C. Penney, which was before either of those guys, during the Depression, borrowed substantially from several life insurance policies to keep his businesses floating, or his business floating. And obviously, all of these people paid the money back and probably bought a whole lot more life insurance that benefited their heirs. And then Hans Scheil borrowed from his life insurance policy to start Cardinal 16 years ago, and he has since paid it all back. And there's no way I could have gotten a loan from the bank or investors to bet on me when I started this business with one person in 2010. Borrowed the money, didn't pay it back for 10 years, and then started paying it back, and it's all paid back by now with no interest cost. There's an opportunity cost inside of the policy, but no interest cost. So, Tom, I want you to respond to that, if you would.
Yeah, I mean, I think one of the case uses for life insurance is it provides liquidity, right? The cash value in the policy, you're able to borrow, you're able to access, and to Hans's point, you're able to put it back, right? That's different than like your investment accounts. It's different than a Roth account. Like Roth money is tax free as well, right? You can access that and have no tax implications. The difference being you can't put it back. Once it's out of the Roth, then that's it, right? There is no putting that money back in there. Whereas with the life insurance, you can. So again, in these scenarios, now you can't like go with some exceptions. We're not going to get into this video, but typically you can't just go put money in now and take it back out. So this is something that's built up over time. You've built up this cash value, and it gives you options. It gives you flexibility to access this money. And again, I think it's just giving yourself choice, right? Where do I get this money when I do this? Another example, at a smaller scale, my parents, they borrowed money. They were moving here to Durham a couple years ago to be closer to us and the grandkids, and they were selling a house, buying a house. They borrowed money out of their life insurance policy. They didn't buy it with the intention of ever doing that. But when we got down to it, I was working with them how to figure out how to purchase this new home before they sold the other one. I mean, just a timing situation. And it made sense to borrow some out, get into the home they wanted, sell their other home, pay it back, and all worked out, right? So I mean, again, there's reasons to do this, even if you didn't set out there with the intention. it's an option to be able to access that.
I mean, one of the cool things about being a financial advisor and a CFP and studying this stuff like my whole lifetime is I have some insight into what the wealthy do to lower their tax bill, to accumulate wealth, to pass it on to the next generation. And so we're just going to look at an example here. The Rockefellers, John D. Rockefeller, he passed, was the close to the richest man in America. I'm not sure if he was the richest, but very, very, very close. His money has lasted 6 generations. In fact, it's expanded. So it's gone from 1 to 2, 2 to 3, 3 to 4, 4 to 5, 5 to 6, and some of 4, 5, and 6 are still alive. And there's almost 200 heirs, like 190 some heirs, and there's like $8.7 billion is the collective net worth of those 187 heirs. And you contrast them to the Vanderbilts. The Vanderbilts were of about equal wealth, and then 6 generations later, those heirs are still wealthy, but not anywhere near like the Rockefellers. I mean, so they're not broke or poor people, but maybe some of them are. But really looking at the Rockefellers, they've been the most successful over the last 100 years of making that money last 6 generations, and it's going to probably continue to last beyond there. So how did they do it? They did it through the use of permanent life insurance and trusts. Okay, life insurance didn't make them their money, but it allowed the next generation to keep it. So it also it pays taxes without selling the assets. So when they own a business, or that whole family owns a business, they would have had to sell the business to pay the taxes to leave the remainder of the business to the next generation. Because they had enough life insurance held outside of the estate, this money was able to just pass generation to generation and grow. So it has to be split amongst 190 people, but I think I could figure that out with $8.7 billion as just get my 190th. And it also reduces conflicts between heirs. So both trusts and life insurance. Yeah, is a key point is this wasn't term insurance that the Rockefellers used, because permanent insurance is just like the word says, permanent. It's in effect when the person, a lot of these people died in their 90s and late 80s, and if they had bought term insurance, it would have been out of force. So point with them, Tom.
Yeah, I mean, I think they are obviously a pretty extreme example of how this can work. And, in most situations, you're looking at scales much less than what they've done. But it provides a good example of how life insurance can provide structure with the combination of the use of trust, where it provides structure, it provides sort of, hands off where they can't access everything. And it's allowed to pass along wealth to the future generations, right? Maybe your goal isn't to do it for 6 generations, and you might not have the billions of dollars they have, which is most people don't. But if we're wanting to plan for that, you've worked hard and saved up your money. Life insurance is a great way to set things up in a way that can be there tax free. If you're worrying about estate taxes, you can have that pass outside of the estate tax there. Now, the federal estate tax limit right now is $15 million per person, but you might be in a state that has a much lower limit, right? Some states have like $1 million exclusion. So a lot more people are subject to that. So maybe we're not talking about federal estate tax, but your own state estate tax could be important that we want to plan around. Life insurance is a great way to be able to do that. And so again, it's a tool. It's something that can be used as part of a plan to pass along wealth to future generations in a way that's known, that's guaranteed, that's not subject to market fluctuations. And it's not with all of your money, right? I mean, the Rockefellers didn't do that with all of their money, but a lot of the money that's still around has been funded through these life insurance policies.
Absolutely. And, the whole point here is if this is such a lousy deal, buying permanent insurance with a cash value, why do all these wealthy people have a history of being involved in? So we move to the next place is if this is such a lousy deal, why do the banks own life insurance? And this becomes a surprise to a lot of you, but the banks in the United States have 205 billion of cash value on their balance sheets. So they have life insurance policies that include cash value, and they're on their balance sheet. 205 billion. So permanent life insurance, and the life insurance is on their employees. They'll start with the executives, but many of them own so much of this it goes down to the middle management. Um, I'm not sure of all the particulars, but this BOLI, bank-owned life insurance, is a thing. You can Google it and look it up, and they own it for the cash value growth is tax deferred. The death benefits come to the bank tax free in most cases. Um, it has stable yields compared to taxable bonds. Um, and it has a predictable low volatility asset for banks' balance sheet. And the point is that it's liquid to the bank. I mean, they're holding it. You say life insurance cash value is liquid? Absolutely. And if you buy a policy that has cash value, it's going to be liquid to you. And a lot of retirees that we get involved in these things just make steady payments, and they're knowing that probably most of them are never going to touch it, but they have the option to touch it if they get into a situation like I was in, where had a big amount of money stuffed into life insurance that had grown substantially, and now I needed to access it. I couldn't pay all the taxes on the growth. So, I mean, it's just the ability to do that within the banks, that they can go access that cash pretty easily without a tax effect, and then they can put it back just about as easily. There are 3,000 banks in the United States that report owning bank-owned life insurance. It's right on their balance sheet. Tom?
Yeah, I mean, I think one of the things that's interesting, right, is it's another asset class for these banks, right? They're owning it as the asset that has cash value accumulation. Like Hans mentioned, that the growth of the cash value, it's uncorrelated to the market, right? It's not directly related to interest rates, so it's something that's moving differently than other the investments are. And if you know the idea of diversification, you want assets that move differently to the ones that you already own. And so again, it's not with all their money, right? It's just a portion of their balance sheets, but it's another way to add a diversifying piece there that has different characteristics. And so again, it's just to Hans' earlier point is if it's such a bad investment, why would these big banks own it, or why would the Rockefellers own it, right? So it's not. Again, this isn't necessarily recommended for everybody, right? That's not what we're necessarily saying, but the other extreme where we get a lot of this is nobody should own it, and I think that's also a disservice to a lot of our clients that are listening or have heard that, right? Again, when built properly, when built as part of a larger plan, it can absolutely serve a role as something that you might want to consider owning here. So what we're going to go next to is sort of the right side of the board and just get into some more of the details of like what the different types of policies are, right? So fundamentally, I mean, there's sort of nuances here in different types of policies within these categories, but broadly speaking, you have term policies and you have permanent policies. Again, within the permanent realm, there's different things. There's universal life, there's whole life, there's different stuff like that. Today's video isn't necessarily peeling all those layers of the onion back on that. Really, we just want to get into sort of broad categories. But let's talk about term for a second. So this is what a lot of people first introduction to life insurance is buying term. Typically when you're young, a lot of times when you're getting married, you're buying a house, you have these liabilities, people counting on you, you start thinking about, or if you haven't thought about, you definitely should be thinking about purchasing term insurance. And this is for a really large need, right? If something were to happen to you in your 20s or 30s, you have a long life of income that you need to support, so you need to be buying a really large death benefit, and typically it's at a point in your life where you don't have a lot of disposable income to put a lot towards the premiums, and so you can get a very large death benefit for a pretty minimal price compared to the benefit there. That's really where term works very well. It's a great thing. We definitely recommend it for the right people. Most people should be buying more than what they really think they need, because you think about you're making 150,000 a year of income right now, and you're in your 30s. That's a long time to have to replace that income for your spouse or for your kids if you were to die before them. So you need to buy probably more than you think, more than you own right now. But again, it works very well covering that need, that risk. Because if something were to happen to you, and no one knows sort of what the future is, it would be hugely impactful for your family to have those benefits there. One of the sort of interesting things about it is only about 1 to 3% of these policies ever pay out, right? So you have all these term policies on the books, these insurance companies sell a lot of them, not very many actually pay out the death benefit. And so that just illustrates the risk that, if you own this is really more for protecting sort of these extreme examples of dying really young, maybe through an accident or some unexpected sickness. Certainly, we can point to examples where it happens, and the life insurance was just life saving for their family. But if we're trying to do it for more of a larger legacy plan, if we're trying to do it for other planning, we'll get into the whole life. Term is probably not the best way to do it because ultimately, just the statistics play out that it's likely not going to be enforced when you die. And that's really what we're doing with life insurance. If we're doing other planning around it, is we need it there to be enforced when you pass away. Term insurance might not be the best tool for that case use. So, Hans, any thoughts on term insurance there?
Yeah, it's fills a need, a great need, and you know, I agree with you. Most people, should buy a million at least, and it's not that expensive to buy a million. And I'm going to tell you that there are many times that a life insurance salesman goes in to somebody who needs to buy term. They have a big need, they have a small budget, and they take that small budget and they sell them whole life insurance, and the person ends up with a really small life insurance that isn't going to do their beneficiaries that much good, and that's a bad thing. And I think that's the root of some of the people that are so against this. That term insurance is great for people with a huge need, small budget. And then what's come out of that is people think, well, I only need life insurance for when my kids are young, or once my kids grow up, um, I don't really need it anymore. I don't need it in retirement. I don't. And I'm going to say that sometimes the conclusion, this is so good, this is the only thing you're going to get. And what we're trying to do with this video is just show you there's two different categories. Both are good. There's not one of them good, the other one bad. And so let's talk a little bit about permanent insurance now.
Yeah, so permanent would be sort of the alternative, right? This one, like the name implies, it's there for the rest of your life. It's permanent. There is no end to that term, right? A term policy is for a fixed period of time and then it's done. A permanent policy is there for the rest of your life. So, by definition, assuming it's still enforced, like you've paid the premiums and everything, it's going to be there to pay out to your kids, to your family, whoever the beneficiary is, they're going to get that amount. So, that is the biggest difference between the two. The other piece that's just fundamentally different between term policies and permanent policies is the permanent policies have cash value accumulation, right? There is a cash value component to that policy, and that's where you get into what we talked about on the left side of the board, accessing it via loans, making normally you wouldn't would do withdrawals on that, but you can access that cash value inside the policy while you're still alive. The other thing a lot of these permanent policies have are ways to access the death benefit while you're still alive. We don't really have this on the board, but it's called a living benefit. So think of chronic illness, you get sick, some type of cancer, some type of needing care, right? That's where you're needing some type of activities of daily living help. You can access the death benefit while you're still alive. That's not what we're really going into today, but that's normally a difference between term and permanent. And ultimately, the purchase of the permanent policies, it can be a need, right? It could be estate planning needs, but oftentimes it's just a want, right? It's like, I want money to go on to the next generation, to go on to my spouse, to go on to whoever it is, and I want it to be there when I die. That's where the whole life, the permanent policies come into play. And so it's not always a need conversation. It could be need could be there, but it also could be a want. I just want this to be able to go to the kids. And that's really where sort of the Rockefellers were, right? Is they don't necessarily need the money, the policies to pass on, but they wanted to preserve the wealth, and that's where that want comes into play. So, Hans, any more thoughts on that?
Well, I just want to take a good comparison, and we just want to talk about, okay, how do we use life insurance in retiring planning as a tool? And too large to mention, but life insurance is another asset class to us. And it's an asset class that you can put money in, and then the money can grow tax deferred. and then you can borrow the money. You can get the money out without a tax. You can get in at some of the growth, no taxes, and then you could put the money back or not. Is if you don't put the money back, there's still going to be a life insurance payout at the very end. It won't be as much because you took the money out. So we use it as just another asset. Okay. And our market, I mean, people, I'm guessing most of you are between 60 and 70 that are watching. I know that from the statistics. And then, you know, it goes down to 55 and 50 and 40. Some of the real planners out there are watching our stuff at 45 and 40. But for the most part, people are in their 60s. And then there's people 70 to 80, 85 watching our stuff. And they're coming back in and we're fixing things in their plans. So it's never too late. But when we're doing the plan in the beginning, this is where the people are following. And where do we use whole life? Well, first of all, it's not with everybody. Okay. If you've got a lot of sickness and you're not in very good health, then you're going to pay extra for this life insurance. And it may reach a point where this cash value perspective is not really going to be good for you. But if you're a couple, sometimes we put the life insurance on the healthier one and then stuff cash in there that can be used. We have such a thing as survivorship life insurance. So I don't want to get into all the stuff, but one of the places we use this all the time, I've just given an example of a male 65 and a female 65. And what we're going to do is we're going to take $10,000 a year of premium for 10 years. So they're going to, when they're 65, they're going to put in 10 grand, 66, 10 grand, so on and so forth. So they're going to pay in $100,000 over the next 10 years. You say, well, I don't have that kind of money. Well, you might in your IRA, because where we're getting this premium is out of the IRA. And so we're going to probably withdraw like 13 or 14,000 a year out of the IRA to net 10 to put it into the life insurance. And that might be just part of a larger strategy where we're doing Roth conversions. So when we're doing Roth conversions of say $50,000 a year or $100,000 a year over several years, we might take a piece of that and stuff it into life insurance because it's going to give us a couple of advantages that we wouldn't have with Roth money growing out throughout your retirement. And I don't really want to get into the details of that in this video. We will in future videos, or we'll just kind of mix that into your plan if you call us and propose it to you if it's appropriate. But I want you to get the idea that what we're doing is we're stuffing cash value, we're stuffing premium, money that would otherwise be in some other form of savings into the life insurance policy, and then let it accumulate for a lot of years. If you die during the early years, this is going to be great for your heirs. If you live a long life, then, and most people are never going to borrow against this thing. Most people are just going to stick in the 10 grand a year for 10 years. They're going to have the life insurance. The life insurance is going to grow in their 80s and 90s because there's so much cash value built up in the thing. And then they're going to die and it's going to go tax-free to their heirs. And that's the big estate planning piece that, I want to check that box, as that's really what we're under today. So the whole purpose of the video was to teach you how we use this, or some of the ways we use this. But the real underlying purpose of the video was just to get you to open up a bit and take a new perspective. We're not going to give you a Pollyannish life insurance sales pitch. We're just getting you to look at it. What you hear in the media, you might want to second guess that. So, Tom, I want you to just react to that a bit before we go into the comprehensive financial plan.
Yeah, I mean, I think ultimately, like Hans mentioned, that a lot of people come in, they have some preconceived notions that this is a bad thing, these are bad investments, it's not right for me, I don't need it, and you might not need it. That could be true, but I think sometimes that gets undersold, right? People just sort of have this idea in retirement, I don't need life insurance. Well, they haven't really thought about what happens when the first spouse passes away, right? If I have a couple and both of them have worked their careers. They have both significant Social Security checks. Well, when one of them dies, not even talking about other money they have, one of those checks is going to stop, right? That Social Security check stops, and they will notice that drop in income. Now, do they have other resource they can go to? Possibly, or maybe not, right? So there is still potentially a need for it in retirement, albeit it could be less. But at the end of the day, we just want to give an idea of this is something that's worth considering. Again, when built as part of a larger plan, it gives you some flexibility. It gives you an asset class that's diversified away from the other investments you have. It's not with all your money. And so we're just adding another piece to the puzzle here. And so it's, again, like Hans mentioned, we're not getting into the details today. This isn't a big life insurance sales pitch and you need to buy this policy for this reason. We just want to get you thinking about, is this something right for me? And if you have questions, reach out. We can look at it and say, yeah, maybe it does make sense or maybe not, right? Again, it's not for everybody, but for the right people, it absolutely can make a lot of sense to include as part of their plan.
Okay, so we're doing retirement planning day in and day out. I already checked the estate box. That's what this whole video is under, is life insurance is the ultimate estate planning tool. And it creates tax-free cash at death. And when we're talking about tax-free, is in my book, in the appendix, there's a 1921 tax return that the tax form, the Form 1040, and half the form is where you would, in 1921, where you'd fill out your taxes. The other half was the instructions. And right under one of the first instructions, it says that death proceeds from life insurance are tax exempt. So sure, that's one of the big reasons for using it in comprehensive planning. We can set up an income out of that. We can actually set this life insurance up later in life to start kicking out a tax-free income to you. We can talk to you a little bit about that. IRA, 401k, many times we're trying to shift in retirement planning money out of the taxable IRA and shift it into something else, which a lot of times is a Roth IRA, which is tax-free. So we're trying to get taxable into tax-free. This gives us an additional alternative, the life insurance, and we have to get the money in there slowly. The government limits the amount of money that you can put into a life insurance policy, that you have to spread it over a number of years. Long-term care, what I want to point out is these hybrid life long-term care policies, they are whole life insurance. Okay, when we peel those back, which we have hundreds of those that people have bought from us, you're buying whole life insurance. That's at the root of the thing. We haven't talked much about Medicare today, and for Social Security, all of retirement planning for people, in this age group that are coming to us, and is you got your Social Security, and then we're setting up your income and your assets in such a way that they shoot off additional retirement income. And so, with that vein, we've talked about Social Security. I'd like to bring Tom back on. I'm Hans Scheil.
And I'm Tom Griffith.
And we thank you very much for listening.
Thank you.